I now hand the conference over to Mr. Kunal Shah from ICICI Securities. Thank you, and over to you, sir.
Thank you, Raman, and good morning, everyone. This is Kunal Shah from ICICI Securities. Today we have with us Mr. Ramesh Iyer, Vice Chairman and Managing Director, Mr. Amit Raje, Whole-Time Director and Chief Operating Officer, Digital Finance, Mr. Vivek Karve, Chief Financial Officer of the company and Group Financial Services Sector, Mr. Rajnish Agarwal, Executive VP Operations, Mr. Dinesh Prajapati, Head Accounts, Treasury and Corporate Affairs, and Mr. Rajesh Vasudevan, Senior VP Accounts from Mahindra Finance to discuss their Q4FY21 and the full year FY21 earnings. So without much ado, over to you, sir.
All right. Thank you and welcome, everyone. It's no secret that the year went by was one of the most difficult years in the recent history any one of us would have witnessed given the pandemic situation. And if you look at the 3 quarters that went by, other than the fourth quarter, which we will talk about, but the 3 quarters went by were very dramatic 3 quarters starting from March, almost last year's March end, when the lockdowns and things like that were announced, which were all an unknown of what that means, will one handle and all kinds of stuff. But over a period of time, the government intervention, the ministry intervention, regulator intervention, tried and stabilized the consumer pressures, and we did sail through those quarters. And then the third quarter was one of its most difficult quarter given what was happening out there. But interestingly, even then we had talked about the month of December, how it was very different from any previous months. And we had kind of made a statement then to say that if December has reflected what it was, we expect going forward things to look good and bright. And we believe that the March that went by, or the fourth quarter that went by, was one of our best quarters, at least in the last few quarters that we are talking of. And very clearly, March in itself was one of the best months that we have seen. From an overall perspective, whether it is from a disbursement that we had during the period, or whether when we talk of collection efficiencies, or when we talk of management of NPAs concerned, repossession disposals are concerned. So from every angle, we saw that the model was tested for its flexibility, the model was tested for its fundamental, and we are extremely happy to say that we were able to take full advantage of the changing events of the market in the fourth quarter and did whatever that we are required to do to kind of pull out the numbers that are already with you all. We did see in every line item there was an action, and I must remind that all of this had happened not that the market had completely become absolutely normal across the country, but I think these are the strengths of model which are built with people who are locally engaged and hired, so who have the better and utmost understanding of what's happening down on the ground there. Their connections with the dealers and the connection with the local administration and with the consumer have all put together actually added to the outcome of the results that is being clearly seen. We did resort to an aggressive stand on negotiating with customer and settling their accounts rather than allowing them extra time if they didn't feel that they would be able to come out of it so very easily. And similarly, even when we repossess vehicles, etc., we did not want to hold them in stock for too long, and we have disposed of vehicles. And as you know, we also moved to bad debt provisioning of contracts which are of a certain age and above. Instead of holding it and negotiating, we felt it's better to make a provision, and after all, we can follow up and collect from the customer. So we've taken some aggressive stand on negotiating and terminating contracts with customers, and as well as bad debt provisioning, and you would see certain increase in those, and I would believe those are one-time cleaning mechanism as well. But overall, it has helped in controlling the asset quality. And also, we are very happy to report that if you look at an absolute value of gross NPA of this March ending versus March 20 ending, we are almost at the same level in terms of the overall gross NPA numbers are concerned. But said that, we did see return of sentiments back to normalcy while there are certain segments of people who continue not to buy vehicle, whether they are from the school bus segment, whether from the tourism segment, whether from the taxi aggregator segment, people carrier segment, because these are the ones which have not returned to normalcy. Even what buoyancy we have seen in heavy commercial vehicle, these are more fleet operators adding capacity, but sub 5 vehicle owners, etc., have still not come back to buying vehicles because they did not see sufficient load. Whereas for all segments, uniformly, what we have seen is while the acquisition cost of an asset has remained high, their operating cost has also gone up. But unfortunately, it has not been matched with their increased revenue either through freight increase or through per passenger fare increase. And therefore, that the segment which are sub 5 vehicle, 10 vehicle operators have not really resorted to big buying. But nevertheless, we did see some good buoyancy in the tractor demand. We did see good buoyancy in the car demand. We did see demand in utility vehicles. And pre-owned vehicle remained aggressive, where people did want to buy pre-owned vehicle, but the supply side also remained. As I said, even from the OEM side, the pressure was on. They could not make vehicles available, even though it was better than what we saw maybe a quarter before. But still, their overall supply position did not substantially improve, as otherwise our own volumes could have been even little higher than where it ended. But on an overall basis, we felt that every line activity was well attended to, and we did get benefit of all of that. And looking at where we were and looking more little into what suddenly started to happen post March, we also felt it necessary to continue with our aggressive stand on additional provisioning. And we have kind of gone ahead and maintained the overlay provisioning at that elevated level. We have also kind of made an additional provision as we would think would be required to bring it below net 4%. And the reason to bring it to below 4% is also for a very clear reason that, the pandemic return has been a little more aggressive. It has been a little more widespread across the country and is also a little deeper in pocket. And therefore, it could take a month or two before we can say things are getting to some normalcy. And this segment of customer possibly would remain under pressure for another couple of quarters before they get back to their normal action and activity. So we only thought it prudent to make this additional provision. And at every stage that we've been having discussions with the regulator, etc., the feeling always we carried was for a company like us with a very high capital adequacy and the nature of business that we are in, the expectation was, could we not make little higher provision and keep it to sub 4% level? And we also thought it, why not if we can? And because after all, these are only provisions. And as things starts to change at the marketplace, we could always get a right back of all of this. But at least we reflect the worst scenario, if you may call, from where we could be. And therefore, we were more than willing to go ahead and take that kind of a position. And that is also kind of we've done. And all of you would definitely remember at every stage asking us a question on, is the coverage adequate? Should you not make a higher coverage? Should you not increase your coverage? So in a way, now we have gone to a coverage ratio which is close to about 60%. So whereas the ECL model demands only at about 30 to 35% kind of a requirement. So we feel we are substantially and adequately covered going into the future. And clearly we see sentiments did return back to positive in March, but it is now subdued. Definitely subdued from customer side. Even I would say it is a subdued sentiment from our local employees at the branch level. Because in the last March-April situation, first of all, we were all caught to an unknown and we were just going along the way everyone was trying to do. But over a period of understanding what the whole thing is, and the rural was not as impacted then, but in this round we have seen it spread across the country, and therefore we do feel our own employees are also wanting to be a little more cautious and careful. So we strongly think that this quarter would definitely be a very subdued quarter if we were to look at the on-ground reality. And once things starts to improve, it does take a month or so. So therefore, in the first half, we would see the activity levels remaining low. We also believe that the supply side from the OEMs once more may start choking because their own supply chains could be under pressure. Because as I said, and I keep repeating, this is across the country. Therefore, the SME segment, who are the component manufacturers and etc., will also come under some pressure from their labor force not being there, etc., etc. And good news is that unlike in the first round, the first quarter of last year, etc., it was a total lockdown. In this round, they are trying to keep the economy going. They are not making it into a total lockdown, but the sentiments definitely are much lower than what it was in the first quarter of last year, because they didn't have to face this situation in the district levels or at the rural level, but they are now currently facing a similar situation. But things are on ground ready to take off, if you really ask me. I mean, if you look at the infra front, the road projects, the mining, all of them were almost commencing to happen. Tendering out was done, contracting was being done. So it was almost ready to happen. And then this comes and halts it for a minute. But I would think if we have patience to wait for a quarter or so, we would see those activity bounce back with pent-up demand coming. So the festival season and onwards could be a very, very exciting time to look at even during the year. Similarly, on the agri front, I think the April crop has been pretty good. So therefore, the cash flows from agri will be very, very exciting. And that's a silver line in the whole thing, that the farming community would continue to do well, and we don't see a pressure from that side. And at least very early predictions of monsoon is also kind of relatively average plus or at least good. And if that was to happen, we would very strongly continue to bet that post-monsoon, the festival season ending up to March will be a very, very exciting time to look at. So we still hold our position of growth coming back to normalcy and getting to some aggressive growth position post-September. From an asset quality perspective, I think we would also continue to see improvement to asset quality. We are conscious of the fact that our AUM has degrown during this period. That's also bringing in an additional impact on the gross NPA position. But I think that's a matter of time. Once the disbursement starts to pick up, the AUM will start to grow. We are all geared for the growth. We have added 150 odd branches during this quarter, which will all get active during the year. We will continue to focus on the cost control, but our happiness will be when some of the cost which has not happened because of the pandemic comes back to reality, because that is going to drive the growth. If there is a growth, there will be some cost which will come in, but the variable cost will remain under control. We have taken some very, very clear actions where we don't believe that the cost will jump back to a 3% plus level like in the past. It will stay put at around 2.3, 2.4 or maybe 2.5 depending upon the volume of business. That's what we very strongly think. As I said, asset quality improvement would only be better going forward from here. You will start seeing further improvement from here, and we are adequately provided. So therefore, the pressure on the P&L will also substantially reduce, having taken that kind of a stand. We do believe that we want to continue maintain the net 4% level of NPA on an annual basis, and we will continue to put all our efforts to first bring down the gross NPA as well as bring in the asset growth to the extent the market allows us. And the third, definitely if there is a gap, we will, if required, to make any kind of an additional provision, a stand that we will also take. But definitely on an annualized basis, on an annual basis, we would control and keep the net NPA hovering at the same level and not inch beyond this. We also see not too much of competitive pressure, but definitely there are players around in different pockets who are trying to enter into some tractor financing. They are trying to enter into UV financing, three-wheeler financing. Everyone is looking for assets, because whichever line of business anyone is, are not able to grow in that line of business sufficiently, and therefore are looking for different lines of business activity possibility. In the same breath, we are also looking at what are the alternate possibility, and that's how we have set up our digital FinCo, which will exclusively operate for small ticket loans for the market, and will offer small ticket loans ranging from personal loans to consumer durables to all of those products. To start with, largely to our existing customer, we have talked about it in the past, but if that is what we do well, by ensuring that we use the data well, by ensuring the digital solutions are provided, and by ensuring reaching out to all those customers and meeting their small ticket needs, opens up a large market for us to even look at customer beyond our customer. So we believe that's a good alternative of growth for us. We are still not looking at loan against property as the area that we are very comfortable to be in. So therefore, we will not want to look at that area for growth. We still think that there is sufficient headroom even in the vehicle space for us to grow. And while we have definitely lost some market share in the tractor business, But again, that was more a conscious decision when we decided in certain pockets to go slow, and we didn't find some other alternate competitors have come in and taken some market share. But I think with our relationship at the dealerships, with the OEMs, and with the local team and the consumer out there, and with a large customer base, once things normalize, we don't find what we've lost is a huge gap to be not able to bridge back. But in as far as cars are concerned, as far as UVs are concerned, we have maintained or slightly grown our market share. So overall, I think it's been a conscious approach during the year. We have taken whenever the window of opportunity have opened, we have been able to capitalize on that. And we continue to believe that at least for the 2 quarters, our approach will still be little more quality focused and not growth chasing focus, because we don't see that as an opening up of an immediate possibility. But nevertheless, we are ready to embark on the growth with all resources put in place and all ready to take it up on that basis. So we think as we close the year 22 going forward, you will see a very different growth trajectory and a different quality of the book. And we believe we have done enough of required cleaning, as well as we have done enough of resource provision and relationship building. And the model has been well tested for its flexibility and its fundamental to be able to gain from that opportunity locally. That's where we are, and therefore summarily we would be conscious for the first 2 quarters, while we'll keep our eyes continuously focused on the changing market scenario and the emerging opportunity, and would capitalize on it as things open up. So is true with all our subsidiary businesses. The rural housing business has done equally well. They also took a conscious view of asset quality correction in the previous year. They went slow on their disbursements, and I think as they closed the year, they also have substantially brought correction to their asset quality, and they are adequately capitalized, and with sufficient liquidity, they would also be embarking on the growth journey post the monsoon from this year. The insurance broking continues to remain a very strategic business, and they continue to grow in line with the growth of the industry and growth of financial services sector business of ours, and they get the benefit of that growth for sure. The asset management company, which is again a small entity for us, but has maintained its asset book and has been able to provide returns to the investors as promised, and therefore we will continue to focus on that business from retailing out in that geography by coming out with products for that geography. But that's still a small business as far as we are concerned. So I think all 3 subsidiaries in India are doing well for us, have embarked on the promised journey, and I think even they would start showing growth and have improved profitability over the period of time. Our liquidity position continues to remain very strong. We are holding just of at least 3 months plus to meet any kind of an eventuality going forward. Our own view is that the interest rates have possibly come off the maximum. It may not probably reduce any further from here, but if at all any during the year, it may inch up a little, but that's not a clear visibility. But reduction from here does not seem to be the truth, but liquidity is sufficiently available, and as you see, capital is adequate, and therefore overall we are ready for growth. And we do believe that the current pressure is not a permanent pressure for too long, may get corrected in the next couple of months, and then after monsoon one would once again see a return of growth in that market. So I would stop there and invite questions from all of you. Over to you, Kunal. Thank you so much for joining this call, and we'll now be ready to take all your questions.
Thank you.
Yeah, Raymond, we can take the questions now.
Yes, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Mahrukh Adajania from Elara. Please go ahead.
Yeah, hi. I have a couple of questions. Firstly, on your disbursals for 4Q, some of the disbursals, like say in utility vehicles, are lower even than 2Q. And of course, they have declined sequentially also. So the year-on-year growth is the year-on decline is understandable. But what happened during the quarter? Why were 4Q disbursals lower than 3Q?
No, so if you see utility vehicle, clearly it's an OEM issue. They couldn't make vehicles sufficiently available, and therefore, obviously we lost volume. And second is some of the products that were made available, at least from the Mahindra staple, were vehicles like Thar, etc., which were more an urbanish vehicle where we didn't have enough participation. So clearly these are the two reasons. One is overall supply was lower and that impacts our volume directly. And little supply that was available were from certain product lines which are more urbanish in nature, and as you know, it's a big waiting list out there, and therefore financing was not a participation in that product. So these are the real two reasons for the utility vehicle drop.
Okay, and what would be the collection efficiency in March compared to say last March, and then if you could give some collection efficiency color even for February and January?
No, so if you look at 3 months, Jan, Feb, March, this year and last year, Jan, Feb, March, I think we were at close to 100 or little over 100% collection efficiency. Standalone March, truly not for simple reason. Last year, March, the moratorium had already kicked in and therefore the demand itself reduced. But nevertheless, last March was 111% after adjusting for the moratorium contract. And this March, in spite of no moratorium, we were at 109, 110% collection efficiency.
Okay, got it. And just in terms of your provisioning, so of course you did mention about it in your opening comments. But to keep NPLs below 4%, would it mean that on what would be the incremental provisioning now on stage 3? Will it revert back to 37, 38% or?
But from a 55, 58% coverage will be come back for 40%. That's what
Sorry?
What's your exact question, please?
The question is that now, so you obviously made a catch-up provision of 13 billion in the fourth quarter.
Right.
But going ahead, say in the next 2 to 3 quarters, on any incremental stage 3 loans, what would be the rate of provisioning?
No, so as I said, 4% would be an annual, not quarter to quarter. Because that will go up because of the economic activity. Forget the current pandemic situation, even on a normal basis. So we will stay with whatever is the reality of the NPA during those quarters and make necessary correction, because the NPA itself will get corrected in the third and fourth quarter. And if that leaves a gap to reach 4%, if there is any, then we would make those provision if required.
Okay. Thank you so much.
Thank you. The next question is from the line of Dhaval Gada from DSP Mutual Fund. Please go ahead.
Yeah, hi sir. A couple of questions. One is on this, new sort of lending opportunity that you've identified in digital. I just wanted to understand what is our right to win in this segment, and what exactly is the target addressable market that we are looking at, and if you could give some sort of strategic direction as to how big this could be in the next 3 to 5 years. How did we sort of select this segment? What is our right to win, and what is our aspiration in this segment? So that is question number one. And second is on the so could you give the write-off numbers for the quarter and for the year? Yeah, those are two questions.
So as far as right to win in digital is concerned, any for any business for that matter, the right to win is if you meet customer expectation. So we have very clearly understood the needs of the rural and semi-urban customer to start with, which is their small ticket loan requirement to meet some of their emerging requirements, whether it's a wedding in the family, whether it is any health-related family fund requirement for health, or for that matter during the agri season, whether for them to buy crop and fertilizers. So there are various needs that have been identified. And the source for those loans in the past, these customers have been resorting to a local borrowing from the family or from the trading community, or some of them even go to a money lender. We have also seen some of them don't pay installments to banks or finance company and use that money for these purposes. So what we have started to initially go into is to a very large existing customer with a phenomenally good track record of at least who have repaid 12 months, 15 months, 18 months of their past loan. and therefore whatever exposure that we may take is not going to overall increase the exposure on those customers. So clearly that's a product designing that will enable that. The second right to win comes from your ability to provide them that loan on or just around the time when they actually need it, and not do it when they don't need it. So therefore, it is extremely important to have a very high level of local knowledge to understand when and what kind of product is required. The third is provide them with convenience and comfort and not hassle them through the current process that they need to go through the banking system if they were to take such personal loans, and which is where we score over the local currently existing organized system, if you may call. And the fourth is the cost of operations and cost of collections have to be kept under control to be able to make all the money that we are planning to make through this process, and therefore use digital and paperless approaches and use the available data while designing product as well as while deciding credit. And in wherever required, this will continue to remain to an extent a phygital model, because not everyone would be able to pay only through digital means. Not everyone will come and borrow money only through app based. But wherever there is a need for partnering with a physical entity is what will be available through Mahindra Finance's branch team, which comes as a very natural advantage having built such a large branch franchise. So put all of this together is what is going to differentiate us from someone else who will now want to come and start the same there. So we want to be ahead of others to reach that market. While doing that, digital being a very uniform possibility, it will also be made available to the semi-urban and urban customer whosoever wants to kind of get into these kind of loan requirement for consumer durables and those kind of stuff. So which very clearly tells us that we have a game in hand and we are going into that market ahead of others, and that's going to position us to be able to take advantage of what we wanting to do, and which is where we created it as an independent internal vertical which will run like a company headed by a COO. Unfortunately, he couldn't be in the call so far, but he would possibly join in as well. But he's going to lead it and ensure that the direction is taken. Aspirationally, we believe that in the 3 years' time, this business can get to, and it won't build a large AUM because this will normally be short ticket loans, which will be 12 months or 18 months or maybe less than 12 months as well. But that doesn't matter. But we will have a disbursement target to start with maybe 5,000, but it is in the 3 years' time capable of going beyond 15,000-20,000 crore. And that's the size of the possibility. That's the size of our current large customer base, and which will build in the next 3 years. And we think that it will build a very strong parallel balance sheet, which will not just add to the overall growth of Mahindra Finance, but also in some form will help retain customer and provide the customer when they look for vehicles after they kind of go through this process of even the small ticket loan.
Sir, if I may ask a follow-up, what is the level of PL on the existing customer base, if you were able to identify what kind of opportunity we have on the existing customer itself?
No, so now itself, when we tested it out in the last about 1 year or so, I think we are very easily able to do, I'm talking in terms of number of customers, we are able to scale without going all India basis, at least 5,000-7,000 customers we have already tested per month basis. So, scale product and the proper structure and resource around that, I think this has phenomenal capability of going up to upward of 50,000 customers to start with, and can scale up to even much larger. Because don't forget that we already have about 2.5 million customers whom we are servicing, and every year we add close to 7.5 lakh to 8 lakh customers. And that's the population which is in-house available to straight away start with. Plus they have their own guarantors who are independent, and if you take even 50% of them is independent guarantors who have good capability, that adds up to another 2-3 million. So I don't think demand is a dearth, number of customers is a dearth. I think we have now put in a proper technology, proper resource, and a right product decision making, and a clear team focusing on it, and that's where the opportunity is.
So my question was actually on the existing customers on the bureau. What is the kind of PL that is there on the existing? Since you said that these customers take loan from other finances as well, so the question was actually what is the kind of outstanding that is sitting on the existing? Just trying to understand, is it a new market that you're creating, or is it an existing market which is going from other?
I won't say it is a completely new market. There are people who would have taken, but as I told you, many of them would have been experienced in taking this loan, not necessarily may have a bureau record already because they would have taken from their family, local traders, etc. So there will still be 10-15% of the customers who originally also had a bureau score when they took loan from us for cars, etc. might have taken some personal loans. So I don't think more than 10-15% of that population would have taken from an organized sector any kind of a loan, and that's what we see. The other 85% is what we see as an opportunity.
Got it. And sir, the write-off numbers.
So the write-off number for the quarter is both termination loss and bad debt put together is 629 crore.
Dhaval, this is part of the slide. Page number 34 provides this.
Oh, okay. Sorry, I missed it. Sorry about that.
No problem.
Thank you. Yeah, thanks for the answers. Thanks.
Thank you. Before we take the next question, we'd like to request participants to please limit their questions to 2 per participant. Should you have follow-up questions, we request you to rejoin the queue. We take the next question from the line of Karthik Chellappa from Buena Vista Fund Management. Please go ahead.
Yeah, thank you very much for the opportunity, sir. I have 2 questions. The first one is this quarter we have run down some of our stage 1 and stage 2 overlay provisions with the result that the provision as a percentage of business assets in both the categories have actually come down. What is your assessment and reasoning behind this? That's my first question. My second question is at a standalone level, the employee expenses are up about 32% year on year. How much of this is attributable, say, to collection-related incentives, etc., and what should be the trend that we should expect going forward? That's all from my side. Thank you, sir.
No, so let me take the second one because, last year, since you're comparing year to year, last year we had a write-back in that particular account because we had made higher provision for incentives and that was no longer required to be maintained, and therefore we had reversed those provisions. And therefore, when you compare last year to this year, the growth seems to be higher. But as otherwise, there has not been a substantial growth to employee costs because even during the year, we have not given very high increment. We have just about given 1.25% for the fourth quarter. That is 5-year annual, but it was only given for the fourth quarter. So there is truly, if you remove the provision reversal that took place in the last year, and if you were to make a comparison, the growth would not be very, very high. So and we have not added too many people. So therefore, maybe little more detail can be provided by Vishal or somebody offline, but largely that's one single reason which is causing that particular difference. So for us, the stage 1, stage 2, the provisioning, the reversal that you're talking of, I think it's also kind of arising out of reset of some model, and maybe Rajesh or Dinesh, if somebody can explain to you a little more correctly in technical terms. But stage 1, stage 2 is also arising out of the reset. So Rajesh, you are there on the call, or Vivek or anybody can explain?
Yeah, I can take this. So hi. So you are right back both in stage 1 as well as stage 2. So what we have done is we have done a refresh of the ECL model. And when we do the refresh of the ECL model, both based on the historical data as well as the forward-looking data, given the fact that agriculture outlook is far better as compared to what it was in the past, some of the ratios certainly has improved, Karthik. And especially in stage 2, because the number has come down, the value of stage 2 assets have come down from December to March, there is also a write back on account of that. So these are the 2 primary reasons why we see a write back in the fourth quarter. I hope it answers the question.
So the way I should understand is the stage 2 asset that you have right now of about 11% provision and stage 1 of about 0.8% is in line with your ECL models post the refreshment.
That's it.
Okay, got it. This is clear. Thank you very much, sir, and wish the team all the very best for the forthcoming quarters. Thank you.
Thank you. Thank you so much.
Thank you. The next question is from the line of Abhijit Tibrewal from Reliance Securities. Please go ahead.
Yes, thanks for taking the question. Again, going back to the disbursements, sir, I mean, initially you explained that some of the supply side issues also led to lower disbursements in auto and utility vehicles. But how do we explain, I mean, the lower disbursements in commercial vehicles and construction equipment? I mean, if we look at, I mean, at least the auto volumes, I mean, they suggest there has been a good growth during the quarter, especially in MNHCVs. That's my first question.
Yeah, so definitely MNHCV volumes have been good, but as I told right at my commentary, they are not by large fleet operators, etc., who are not our consumers. So we not be saying maybe large fleet operators because their need of both in terms of quantum of loan, period of loan, rate of loan is not something that we are participating in, and they're not to take benefit of the growth that we have seen. And we are conscious of that fact, and we don't want to shift our strategy based from a sub 5-10 vehicle owner to a large fleet operator financing.
Okay. So the other question that I had was around the branch expansion strategy. So, I mean, you have added close to around 140 branches during the quarter. And this looks especially stark given that, I mean, over the last 2 quarters, you had actually reduced your branch count by around 80 branches. And even if we look at the branch additions during the quarter, I mean, I see they are largely concentrated in the states of UP, MP and Rajasthan. Close to about 65-70% of your new branches have come up in these 3 states. So I mean, how do you look at, I mean, expansion of branches in these geographies? In other words, if you can give some kind of a geographical color or some thought process that has gone into opening newer branches, especially when we were kind of rationalizing our branches over the last 2 quarters?
So clearly, our branch opening is very simple. We look at size of a particular branch, how many customers are we handling, and the distance of the customer from the branch. And therefore, cost of operations and the efficiency that you would get by that approach versus splitting the branch and opening more branch and be more closer to customer. The second that we look always is that what is the emerging potential in the area where your consumers are, and if you were to have a branch, is there a potential and opportunity grow a little more? The third we look for is what are the OEMs plan in terms of penetrating and what are they expecting from us, and is there a reason for us to participate in that expansion program of the OEM and partner them and go deeper. The fourth, the closing of a branch comes from similar approach to say that is the branch anymore required in the location in which we are, because we would have originally started that branch with an idea to do, let's say, a tractor business somewhere. Then over a period of time, we have found that that area has become multi-product need and may not be driven only by a single product. Now, if your branch is located somewhere only a single product attention can be higher, then we have to relocate the branch. So you must look at our overall program. From some branches would shut and get relocated. Some branches split and more branches would get for the reasons I explained. So just one more example would be Maruti is very clearly looking at going deeper into rural pockets, and they have a very ambitious plan of growing from those smaller outlets which are in deep rural pockets. Now, we are their natural partner to be participating in that. That calls for us to have had more. Now, the states that are up to MP, UP, Rajasthan, whatever, are all large states, and the size of per branch already has become too large, and the area that the branch needs to cover also has become too vast. So therefore, we have added our additional branches to be more closer to customer. Those are the reasons. And once you have those kind of more branches and look at much wider coverage and a larger customer base, then your natural growth of your ability to do higher disbursement begins to happen, and you have a more closer connect with the customer when it comes to even recovery.
Thank you. The next question is from the line of Nishin Chawate from Kotak Securities Limited. Please go ahead.
Yeah, hi. We ended the year with a ROA of 0.4% and return on net worth of around 2.5%. I believe some of the other NBFCs who are operating in very similar segments are yet to report their results. But if I look at consensus numbers to go by, I guess the market is expecting, at least a 1% ROA and a double-digit ROE from them. So just trying to understand as to, what is it that they are doing differently or we are doing differently, and why there is such a stark difference in performance.
So very simply, Nischint, look at we made this 13-20 crores of additional provision to bring it to sub 4%. Right? If that was not to happen, then I think we would have met all those expectations in some form. But the reason to bring it also below 4%, and we know for a fact that this business, in the not a net 4%, because these are seasonal businesses, these are earn and pay business, and it will go through that some time of this kind of pressure. And in the past, we have had on its own a net 4%, and now we are by additional provision brought it to 4%. That's the only difference between the model that we run versus someone else runs. But as we go into the future, things starts to correct itself. Market improves and our asset growth comes back. And we will actually release the provision that we have made already, and you'll suddenly see a jump in. So this, we are willing to go through looking at a very uncertain, unknown. Our capital has gone up, and we have not been able to gear the capital completely for growth purpose. So the growth has to come back to some, and once the growth comes back in the market.
I'm sorry to interrupt you, Mr. Iyer, but your voice is breaking. It's cutting off. We can't hear you very clearly.
Sorry? Can you not hear me?
Yes, your voice is breaking. Request you to move to an area with better reception.
No. I have a full range.
Okay.
I don't know. Is that the problem? Everyone is not hearing me? I don't know.
Yes. Your voice is a little muffled.
Okay, so let me try instead of... Okay. Is this any better?
Yes, sir, much better. Please go ahead. Thank you.
Okay. No, so I was saying this, the capital is large now, and we are not being able to fully utilize it well because the growth is still not there. So once the growth has to come back to some normalcy, as well as we know in that market, once growth comes to normalcy, the collection on its own also improves substantially. That will bring down the gross NPA as well, and the two together will push up the ROA for the ROE to be better. But as otherwise, currently, it's a conscious decision to make this extra provision looking a little unknown into the future. And once things starts to improve, even the additional provisions made can get little released.
Sure. And just curious, what was the feedback at the ground for the last 20 odd days of this month?
So the feedback of last 20 days has been very mixed feeling. I think in the first time I heard our own employees saying, they and their families are wanting to be more careful from the situation, which was not what we heard, let's say 1 year back when the pandemic hit. It didn't reach rural, and they were looking at from a distance from there to say, what is the real problem? We don't face it here. But whereas in this round, I think we have been able to see our own people going through this pressure. So that's been one very strong feedback to say that, we would also be little careful kind of a situation. So I would expect clearly that not every dealership is going to be up and running. Not every branch is going to be up and running for at least for another 1 month or so. The second feedback that we get is that while there has been not a total lockdown announced, but every state is contemplating, going through some administrative controls and not allow things to happen the original way. So that's the other feedback, that things will slow down a little, which is going to have some impact on the contracting segment. The labor may not be fully available for job on the ground is the third feedback that we surely get. But the positive feedback that we get is customers have the money. The agri flow has been very good. Even the infra contracting segment has already received the contracts, etc., and therefore was to begin the activity, but that has been now slightly put on hold. So they say in a month or two, as things settle down, it will really open up with great speed and with a spurt, and therefore the demand could really spurt from then on. So overall, that's the sense and feeling that we get. From a customer side, the feeling is, we have the money, but we would like to hold it for some time. Give us some time. Let's see how things pan out, and then we will start participating again in either buying or even discharging liability.
Thank you. Before we take the next question, we request participants to please limit their questions to one per participant. The next question is from the line of Sanket Chedda from VittiMarkets Securities. Please go ahead.
Yeah, hi sir. Good afternoon. So my question was on provisioning. On part of it has already been answered. So just wanted to check the review of.
Mr. Sanket, I'm sorry to interrupt, but we can't hear you very clearly. Request you to use the handset.
Hello, is it clear now?
Yes, sir.
Yeah, it's clear. Yeah.
Please go ahead.
Yeah. So just to dwell again on the yearly review that takes place on LGDs and PDs, wherein your PCR needs are determined on stage 1 and stage 2. You highlighted what was the levels that came out of that rerun of the LGDs and PDs, but on stage 3 in last Q4, maybe we thought that the PCR needs to be hiked by at least 30%, so we brought it up from 30% to around 40% levels. What is the current requirement based on the rerun that you've done on stage 3? So what I'm asking is, you intend to keep the net NPAs at 4% levels. So if at all going ahead there are tailwinds along with the growth that persist, are we only going to see provision write-backs with the absence of credit cost completely? So yeah.
Okay. So I can take this question, Vivek here. So as you rightly pointed out, we have our percent in to the bottom of LGD calculation. So we have basically continued with that particular stance. Although the pristine LGD calculation is a number which is lower than that 40%. And going forward, our idea is to maintain the NPA at an annual level. So if the GNPA performance is favorable, it will provide us an opportunity to do so.
Thank you. The next question is from the line of Shweta Daftardar from Prabhudas Lilladher. Please go ahead.
Thank you, sir, for the opportunity. So referring to slide 32 of our presentation, so the number which you mentioned on moratorium availed contracts, which is around 14,70,000 odd, and the number of contracts from where we received nil payments have gone as high as 2,70,000 odd, which quarter on quarter I think has, if I just put it in percentage terms, has risen from 6% last quarter to 19%. So, and while if I look at the table above that, the collection efficiency for past 3 months have been closer to 100% or higher than 100%. So what has happened, with this moratorium availed contracts? Were they critical even before the COVID period? How was their behavior like? Were they in the stage 2 almost, kind of ripe to fall into stage 3? So what has happened? What has been the customer behavior prior to COVID as well? Because this number is only going higher, whereas the collection efficiency month on month is only improving.
No, so first let me clarify to you that they could not have been a poor quality customer before anyways, because moratorium would not have been given if they were already a delinquent customer. So that is not right. So they were a regular customer when the moratorium was definitely offered to them. Now, whatever slides that you're referring to, Vishal or Dinesh, can somebody take?
I can take this. So I think we owe a clarification to you. The way to read this is 14,73,094 are those customers who are available some amount which fell due in Q4. So out of the 14,73,000 customers, 7,384 customers did not make any payment in Q4. So that is the first line of that table. the second line you have to read like this: out of these 14,73,000 customers, 2,74,061 customers had not paid any amount till September. And out of these 270,000 customers, there are 37,263,000 customers who have not paid any amount in H2 also. So that is how you need to read the table.
Okay. But again, I'm slightly confused. I continue to remain confused because then if you mentioned, the amount due in Q4 and the total number of contracts were 14,70,000. But if I look at Q4 collection efficiency, wherein the denominator is current month demand due for the month, then that number is still, I understand it is for that particular month, but the collection efficiency still looks 100%. Whereas we still have customers, which you rightly mentioned, in second half did not make any payments at all, which is around, say, 3%.
Yeah, so Shweta, the collection efficiency to be calculated with the total collection that is current demand.
Okay.
Yeah.
Vivek, what I suggest is, Shweta, we can take an offline discussion on this.
Yeah. We can explain everything to you.
Yeah, sure.
Thank you. Before we take the next question, a reminder to participants to please limit their questions to one per participant. The next question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
Yeah, thank you, sir, for the opportunity. Sorry for being a bit repetitive, but it is regarding the decision to bring the net NPAs below 4%, and you do mention that it was based on the RBI's expectation. So if one reads between the lines, is it fair to say that this could be one of the softer requirements by the regulator if they were to kind of consider you for a banking license applicant, or it has absolutely no relevance or no read through from that perspective, sir?
Honestly speaking, I have absolutely no clue to read into their minds or your minds. So it's very difficult for me to answer either way. But I would like to be more clearer when we say RBI expectation. They all look at the market, they look at our capital position, they look at our past approaches. So it is natural expectation to say that a good brand like Mahindra, a large company like us, very rural focused company with high capital adequacy, they will always want to discuss, deliberate and say, don't you want to make higher provision and keep your net NP at lower levels, whatever. Now, we will not want to just do it if somebody's expectation is, or unless we also somewhere believe to say that what is wrong if you make some additional provision. After all, it's only a provision, and if the market conditions were to improve, it helps you release back the provision whenever that situation does arise. So I have always said, even in the past, that provision should be differentiated from an eventual credit loss that the company will incur. Now, if we make some additional provision, it is fair to have the provision, and all of us are going through so much of unknown, right? I mean, I don't think all of us, whatever we are saying, things may change in a month or two, etc., is more whatever we read, we hear, etc. But there is not a clear, full understanding of the pandemic situation, how it is going to pan out, or how it could be faster than we expect, and then things can start to change. But the overall market condition seems to be a little confused, and sentiments remain to be a little low. So we have taken this decision to do it, and which is why I said this will be an annual feature and not every quarter feature. And you are right, 2 quarters down the line, market conditions may change, collections may improve, the customer cash flows could be substantially better, and the gross NPA comes down, then the provision may no longer be required also.
Thank you. The next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Sir, thank you. So one reason why you said was the 4%, and you also mentioned cleaning up the book. So I just wanted to know whether, given the fact that Mahindra always gets in the customers whose ability may be a problem, but willingness is never a problem, is there something which you do strategically going forward which would shift the business away from the current set of customers? And whether the digital also would include two-wheeler loans that we had spoken about earlier. Thank you, sir.
Yeah, so the digital will include two-wheeler loan, but we are not yet started that. But definitely the two-wheeler OEMs, the two-wheeler dealers, and as I have said in the past also, many of the dealerships that we work across the country are also two-wheeler dealers. So they are continuously in dialogue with us to say, do you want to start? When will you start? Kind of a thing. So definitely that is in our radar, but may not be very immediate. But we always consider two-wheeler as in some form of a personal loan only, because repossessing those assets, etc., are not the true answer to success there. So the answer is yes, two-wheeler will be looked at. So far as whether the model is undergoing a change, etc., I think when I use the term cleaning up, it was more in relation to the bad debts and termination losses that we have incurred. We said we have reviewed all those customers who are a little high aged, and rather than following up and trying to pick up monthly installments, etc., it was felt more prudent to negotiate with the customer and settle the accounts with them rather than invest any cost of recovery over a long period of time. Similarly, on the bad debts, wherever we wanted to take back the vehicle, sell off the vehicle, we have done it aggressively rather than holding it and then delaying those actions. It was not from the provisioning perspective. We continue to work with earn and pay segment. We continue to work in the rural market. We continue to work with customers who bring in 15, 20, 25% margin money. We continue to work with customers who will go through the seasonal impact of the agri cash flows and infra cash flow. So, and our branches are geared to only handle those kind of requirements, and our people who are recruited locally understand this well. So I want to be extremely clear to say that the model is not undergoing any change, nor are we seeing a substantial change in the customer segment and sentiments from that segment. So we are not shifting our gear to say, oh, let's go to high-end customer and drop these customers. No, that's not what we are saying at all. The cleaning up comes from, I repeat, from the repossessions, disposals and settlement with aging customer by offering certain concession and closing the contract.
Thank you. The next question is from Anirvan Sarkar from Principal India. Please go ahead.
Hi, thank you, sir. So my question is regarding your movement in stage 3 assets. If I look at the trend in your earlier years, traditionally Mahindra Finance has done phenomenal recoveries in the fourth quarter of every year, which usually led to an absolute decline in stage 3 assets. And usually that decline has been in the range of anywhere between 50 to 20% on a sequential basis. And given your commentary in the last quarter, when you said that you have not restructured any of your customers because they did not want to be restructured and they were confident of being able to repay in this quarter, we would have expected a similar decline, but that's not the case here. So either recoveries have not happened to the extent that we thought it would happen, or slippages have been higher than we expected. What is exactly the situation here?
No, I didn't understand why you are saying decline has not happened in terms of gross NPA. Is that what you are saying?
Yes, that if I talk of the absolute quantum.
Yeah. So if you look at December end, if I'm not wrong, I don't have the figure ready, but I think we were gross NPA of 6,600 or something like that. And that's come down to something like 5,700.
Yes, you're right.
Yeah. I get it now. Sorry, my bad. So just wanted to, I have looked at the wrong number here. So sorry
okay.
for that. But my question remains that, on the recovery front, so what exactly is, have we recovered to the extent that we thought we would, or, and regarding slippages, what has been the situation? Has it been according to expectations, or how has it been like?
In my opinion, it has been, I said it in the initial commentary also, it actually met or surpassed our expectation because, as I said, March standalone, the collection efficiency was 109, 110%. And if you look at each bucket, whether it's in bucket 1, bucket 2 or bucket 3, in every bucket we have seen reversal and the size coming down, which means the backward flow has been good. And even though the gross NPA is still at 8.8, it's also caused by the asset not growing. In an absolute term, if you look at our gross NPA 31st March now and 31st March 2020, we are exactly at the same number. So we are more than happy with what has happened, even given all the pressures that the market was going through. I think fourth quarter has definitely served us what we were looking for, or in fact, it's been slightly better than what our expectations would have been.
Thank you. We'll be able to take the last two questions. We take the next question from the line of Aditya Jain from Citigroup. Please go ahead.
Right, thank you. Just clarification on the ECL model. So is my understanding right that you more or less reverted to the pre-COVID PD, LGD levels in stage 1, 2, 3, and then the overlay is completely outside of these provisions, of these assumptions. So you make certain assumptions, but in addition to that, you're making the overlay, which is completely management discretion. Is that right?
That's right.
Right. Okay. So if you could.
Vivek, you were saying something. Go ahead. Dinesh, Vivek, you were saying something? Somebody was saying something.
Yeah, I just thought I will share here. There is a continuity of some percentage of overlay over and above the LGD and PD ratio. So if you see the breakdown of the overall overlay, we continue to have around 966 crore as an overlay. And there is an additional provision which was made as per the RBI expectation to bring the net NPA below 4% of 1320 crore.
Got it. Okay. Just a clarification on the cost. So it's within the 2.5% cost to asset guidance, but it's still up 25% QOQ, while disbursements are lower QOQ. So are there any one-offs, or is there any other factor which is driving the sequential increase?
Dinesh?
So in,
anybody there? Yeah.
Yeah. So in current quarter, there are few one-off, but that is very small, negligible number to share. One is because of the Supreme Court order, there is an interest on interest provision, around 32 crore worth of provision has been done in the quarter. And obviously because of this drive of settlement and the reversion activity which was done in the current quarter higher, to that extent there was a incremental higher cost incurred on account of that.
Thank you. We'll be able to take one last question. We take the last question from the line of Umang Shah from HSBC Securities. Please go ahead.
Yeah, thank you for the opportunity, sir. I just have one question on the rural housing subsidiary. I mean, it's been 5 consecutive years where we have had net NPLs of 10% or above. Should one assume that that's the nature of the business and that's how elevated the NPLs will continue to remain going forward as well?
While it has remained at that level, our belief is that the gross NPA of this business may be 6-7% and not net at this level. And as I've been repeatedly saying, we continue to have 40% of the book or so, which is coming from Maharashtra. And it's no secret for all of us that Maharashtra has not been going through a great time continuously for more than 3 years or so. We are only now seeing after a good crop, things are beginning to change. And once this state gets a correction in rural housing book, you will see a substantial sudden dip to the net NPA that can happen. As otherwise, this is not the level that is expected to be kept for this book. And Maharashtra needs a correction. I don't know if Anuj is in the call.
Yeah.
Anuj, you want to explain a little more?
No, I agree. I agree with what you're saying, that it is our dependence on one state. And the good news is, at least in the last quarter, we saw that state also improving when the cash flows improved. Rural cash flows everywhere improved, including in Maharashtra. But for the COVID resurgence in the first quarter, we would have continued to see an improvement in that. And if this improvement continues further, I see no reason why we can't bring the situation under control.
Sure, thanks. And can I just squeeze in one clarification from Vivek?
Yeah, quickly. Yeah.
Yeah, please. Yeah, sure. Vivek, you mentioned that 37,000 odd contracts have not made any payment in 4Q. Fair to assume that these are the guys who haven't paid anything since the beginning of the moratorium, right?
Precisely. You're right.
Okay. All right. Thank you so much. That's all from my side. Thanks and good luck.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to Mr. Kunal Shah for closing comments.
Yeah, thanks a lot the entire senior management team of Mahindra Finance for sharing the insights and perspective and clarifying all the questions. And thanks all the participants for being there on the call. Thank you and have a good day.
Thank you, Kunal, for hosting us. Thank you so much.
Thank you, Kunal.
Thank you.
Thank you, everyone.
Thank you, Kunal.
Thank you.
Thank you very much. On behalf of ICICI Securities Limited, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.